the owner actually committed fraud and cooked their books. And one of the reasons we didn't find it is because they were also taking money out of their personal account and making it look like all of their residents were paying rent. The property that looked like it had somewhere between 92 and 94% economic occupancy actually only had 60% economic occupancy.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com. Hello and welcome to episode 105. Today, we're going to talk about increasing your wealth exponentially by investing in multifamily and apartment properties. And here to have this conversation with us is Anthony Chara, the president of Apartment Mentors out of the greater Denver area. And Anthony, along with his investors and students, has bought and sold over 1,700 units worth over $45 million. Anthony will also be a featured speaker at the RPOA's annual free Real Estate Investor and Landlord Expo and Conference, which is happening right here in Grand Rapids, Michigan on February 22nd through 24th of 2018. And you can go to rpoaonline.org to register for free. Anthony, I'm always up for a good conversation on multifamily and apartments. That's kind of my bread and butter. I'm looking forward to having this conversation, and I'm especially looking forward to hearing you come speak at the conference in February. Thanks for being on the show today.
Sure. Thank you, Brian. And I look forward to coming back to RPOA again.
Why don't we get into just the beginning? How did you start investing in multifamily and apartments? Why did you think that was a good idea?
Well, it's a great question. I actually started in single-family homes way back in 1993 and did that for about 10 years until about 2002, 2003. It just hit me that single-family homes, while they were good investments, they just seemed to be very slow in getting me to where I wanted to be. And I ended up going to a meeting. It was actually a business opportunity meeting. Somebody was trying to get me and several other people to invest in a business that they were trying to start. And we went around the table and everybody introduced themselves. And one of the gentlemen at the table, his name is Ron, he told me about how he had 450 apartment units, or he actually said that to everybody during his introduction. I was like, aha, this is perfect. This is the next step that I want to get to. I had about 9 or 10 single family homes and condos. I was looking to get to that next level. So I asked him if I could take him to lunch. Sure enough, he said that would be fine. So we went to lunch, and over about an hour and a half, 2-hour lunch period, we talked about his background and how he got to where he was. And one of the things that really hooked me was that in his heyday in the mid-1990s, he had 450 units, and he was making $140,000 to $150,000 in passive income every single month. And it's like, okay, that's...
Wow.
That sounds great. That's the next level I want to get to. So I started learning from him. I took some other classes and then got some partners together, and we went out and we started buying apartments in 2004, and we haven't looked back.
So timing is everything. And if you were buying in 2004, then a couple years after you started, you must have felt some pain from the bubble bursting.
Well, I did, but it wasn't from the apartments. It was from the single family home side. The apartments did fine. What a lot of people don't realize is that apartments are generally built for cash flow. And so our apartments actually did just fine through the bubble burst. It was all the single family homes that were completely upside down. I had a few single family homes that I bought in the Las Vegas area for about $285,000. And by the end of the 2000s, probably 2008, 2009, 2010, somewhere in there, they were selling similar homes in the same neighborhoods for about $100,000. Mm. Yeah, and that happened to me in several properties. I had properties in Vegas, properties in Arizona, and even properties in Florida, and they were all drastically upside down. But the apartments did just fine. They held their own through the late 2000s, and then they started to increase in value in 2009, which is when apartments actually really started to take off in most areas around the country, 2009, 2010. And a lot of those areas are still extremely hot today.
Yeah, no doubt. Now, so you've seen firsthand the difference between investing in single families and apartments. What are some of the other reasons that you like to give for investing in multifamily and apartments?
One of the biggest things that I like about investing in apartments is the fact that I have more control over the value. Unlike single-family homes where they sell based on supply and demand, which is also driven by emotion, which is what basically crashed the market in the mid to late 2000s. Everybody basically panicked and started walking away from properties and walking away from their mortgages, and things just got worse and worse and worse. But with apartments, because they're generally based off of the income stream that they generate, as long as you can continue to hold the income stream or even increase the income stream, even by doing something as simple as raising the rent $10 per month per unit, you can actually increase the value of your property tens of thousands or hundreds of thousands of dollars every year. And you can't do that in single family homes. You raise the rent $10 a month. Well, next year your home may go up in value. It may go down in value. With apartments, when you raise the income stream and increase the income stream, the value of the apartment goes up, period.
Going back to that first deal you did, you talked to this new acquaintance of yours who had 450 units, making a killing in apartments and multifamily. How did you go about making that transition from owning single family to putting together a deal where you brought investors and partners into buying your first apartment building?
Well, the first one that we found, I actually met up with a couple of partners who wanted to get into apartments as well around the same time that I met Ron. And so we went out, we just started looking for apartments around the country. We ended up finding one just outside of Oklahoma City, down around Norman. And it was a 14-unit property. And what we did is we went to one of my partners' families because they had some extra cash sitting around, and we knew that they would probably be one of the easiest places that we could go to get people to invest with us is through family and friends. So sure enough, we went to them, told them what we'd found, told them how we valued the property, told them what we were going to do with the value of it and increase the value of it over a period of time. And being family members of one of my partners, they said, sure. So they ended up investing with us. And that's how we got our first one done, was that first 14-unit property. Once we got the first one done, then we could take the results from that one and show other people what we were able to do. And then money continued to flow in once we could show our track record. And so we've just been doing that ever since. We've been raising money from outside individuals. We hardly ever use family and friends anymore. But if they're still interested in investing, we're certainly welcome to have them join us. But right now we've got a big enough group of people in our database that we can go out to some of these other investors and raise anywhere from a couple $100,000 to a couple $1 million, generally within a short period of time, in order to get a decent deal that we found.
And are you investing all over the country, or are there specific areas that you like to look for apartments?
Well, when I was first looking for apartments, we were looking in the Midwest. We were looking at places like Oklahoma, Nebraska, and Iowa, just because there's a lot of good, stable markets in those areas. There's a lot of people that were raised that it's important for them to pay their rent or pay their monthly mortgage payment on time. And so that's where we started. But now I invest all over the country. And most of that is driven by my students, because I started teaching back in 2006. And now the students are going out, they're finding their own markets. A lot of times it's their own specific market that they live in. Other times it's areas where they want to go visit, or maybe they have other family and friends, so they're looking for other markets. So once they find a property, we not only research the property, we research the market to see what's going on, to see if it's going to continue to be a strong market, if it's increasing in population, if it's decreasing in population, what kind of jobs are being driven or brought into that market. Just the economic gains that are going on within that particular area to increase the value of the property, because ultimately it's the increase in population in different areas, which is usually driven by an increase in jobs, that drives the economy in the local market. So once we find a good deal, or a student finds a good deal, we then research the market to make sure it's a viable market. And if it is, then a lot of times we'll partner up and we'll help them raise money. We'll end up pulling down anywhere from a 60 unit to, matter of fact, we just did a 60 unit. We're working on a 60 unit right now in Iowa. And the biggest complex that we purchased was actually a 4-complex portfolio, was 410 units up in Indianapolis.
It sounds like you put a lot of emphasis on the area that you're investing in, the community and everything. What are some of the other things that you look for when it comes to doing your due diligence on whether or not you should buy one of these properties?
Great question. So one of the other big things that I always tell people that they need to be aware of is the crime rate in a particular market. Certainly, every single market across the country is going to have crime. There's no doubt about it. But what I'm looking at is the severity of the crime and the quantity of the crime. And there are some areas around the country where crime is rampant. Generally, there's a lot of violent crime in certain areas. There's assaults, whether they're physical assaults or somebody used a weapon of some type. I'm not interested in those types of areas. Now, if we found a property that has some issues at the property, but the surrounding area is fine and it has little to no crime or little to no violent crime or drug-related crime, things like that, I would probably still be interested in purchasing that property because I believe we can change the property, but I don't believe we can change the neighborhood. So I don't want to create an oasis in the middle of a bad crime area. So I'll tell people that they should go out. There's a couple websites you can go to. One of them is crimereports.com. Another one is spotcrime.com, and you can see what's going on with crime in a particular area. You can also go to Zillow. Zillow even has some heat maps where they show crime in areas. But no matter what comes up on any of those sites, you should always go to the local police department and ask the local police department what kinds of crimes are happening in the area, the severity, how violent those particular crimes are they drug related or weapons being used. You should still go to the local police department to find that information out. I also, besides the crime, generally I want to look into what's happening within businesses in that area. I go to places like bizjournals.com because I want to see what's happening within the business community. Or businesses hiring people or businesses laying people off? What's the general business climate? Is the government pro-business? And are they encouraging businesses to come into their market? And of course, the last thing that I want to look at, or one of I shouldn't say the last thing, but another very important factor is whether or not the state and or the location where the property is situated is landlord friendly or tenant friendly. There are a few areas around the country where you find some pretty decent deals, but they're so tenant friendly that literally it can take you 3 to 6 months to get somebody out of the property when they're not paying rent. And that's just ridiculous to me. So I avoid areas that are too tenant friendly, and I look for areas that are more landlord friendly, because if somebody's not paying the rent, I feel sorry for somebody if they lost their job, but I still have a mortgage payment that I need to pay on that property, and I can't pay it if multiple residents aren't paying their rent.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat-fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So is that pretty much a deal killer for you then if it's a tenant-friendly area?
It's not necessarily a deal killer. It depends on how friendly they are. There are some municipalities that get it. They understand that residents can't pay the rent. There are areas that understand that, and they still let you get tenants out within a reasonable time, usually within a month or two. But there's other areas around the country which are so tenant friendly that it can take 6 to 12 months. I actually had one of my partners from years ago actually sold a bunch of properties in California because he was getting out of California because they had changed the landlord laws so drastically, or they were about to, that he could foresee it taking 12 to 18 months to get somebody out of the property if they knew how to play the system right. And you can't make money doing that. And certainly, again, I understand that people lose their jobs, people get divorced, a spouse passes away, and people run into trouble. But at the same time, I still need to be able to make my mortgage payment. Otherwise, we lose the entire complex. And then the whole thing goes down. If we don't have the money to pay the mortgage, if we don't have the money to make repairs, no one's going to be happy. So it's unfortunate that that happens. But so back to your original question, it's not necessarily a deal killer, but I want to find out how tenant friendly. There's certain degrees to landlord friendly and tenant friendly, and it depends on how far the pendulum is swinging to each side. And some of it also depends on the overall numbers of the property. There are some things that we can overlook if the numbers are that outstanding on the property itself.
Sure. Going back to the crime, you said it's easy, or it's not easy, but you can change the community or the apartment complex, but you can't change the neighborhood. What are some of the things you can do to change the apartment complex?
Sure. Well, the first part of it starts with getting out any troublemakers that are in the property. And that's one of the things that we'll research during our due diligence process. We'll look at all of the residents. We'll look at their payment history. We'll look at any type of written letters that are in their file. Maybe they had issues with loud music. Maybe they've had charges against them or allegations leveled against them for drug dealing or prostitution or any number of things. Or maybe they've gotten into fights with their neighbors. We've had a few properties where it's not even the residents that are the problem. It's the people they invite over. We've had, matter of fact, we've got one property right now where a grandfather's living in our property, but his grandson is coming over to the property and apparently selling drugs. And we've had the police there a couple times. Well, we had to warn the grandfather that if the grandson ever came back to the property, we were evicting him, the grandfather. But we can't evict the grandson because he's not supposed to be there in the first place. But if we basically warned the grandfather that if the grandson comes back, he's out. And that was a couple months ago. And thank God for right now, the grandson has not come back because he's causing other issues. So we'll look at things like that. We'll also talk to the local police department to find out what's going on. A lot of times they'll tell us if there's any type of gang activity on the property or drug dealing or the prostitution or anything like that. And literally what we'll do at that point is we'll work to see what we can do to legally get those people out as fast as possible. One of the things that we choose to do is we'll just tell them that we're not renewing their lease. So we'll give them their 30 or 60 days notice when their lease is coming due, and we'll let them know that we're not going to be renewing it. And they're going to have to go find someplace else because they're no longer welcome at our property. We've also worked with the local police department. So if somebody is causing issues, we'll work with them. We'll give them free access to the property so that they can come on and do what they need to do to either arrest those people or show enough of a presence that they leave themselves because they want to go someplace else where they're not being followed by the police and other people to potentially go to jail. And that's one way to turn the community around. And then the last step, once we get out the troublemakers that we know are already in the property, is to improve the screening process on the front end and how our property management company decides who actually gets the keys to the property in the first place.
Let's talk for a moment about Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers, and how their exciting technology can help you control property access to vendors and potential tenants. No more time wasted waiting for late appointments or no-shows. Oversee energy usage and analyze data in order to reduce utility and maintenance expenses. Eliminate the cost of keys or rekeying locks. Command higher rents and increase tenant retention, and provide tools for tenants and managers to monitor the property to improve safety and security. And it's all done through cloud technology, utilizing encrypted data and private cellular service. And best of all, the return on investment of installing Point Central's technology is upwards of 25% a year. The future of property management is here, and you can find out more by visiting pointcentral.com.
You bought
and sold over 1,700 units. What are some of the unexpected challenges that you've faced when taking over a new apartment community?
Well, some of it is sometimes we can have surprises with what I just mentioned, with the property manager not doing a very good job of tracking problem residents. A lot of times when you're in there interviewing them, they'll tell you, oh, everything's wonderful, everything's fantastic. And then you find out after you buy the property that things aren't so wonderful and fantastic, that there are some troublemakers on the property. So we'll have to go in and clean house. Sometimes cleaning house includes getting rid of the property management company because they misled us at the beginning phases. We generally, when we buy a property, we leave the current management company in place unless we have a suspicion that they're part of the reason that the property isn't performing as well as it should be performing. In that case, we'll make a change at the time that we buy the property. We'll get rid of them. We'll bring in a new property management company, and then we'll go in and start straightening things out. Another challenge it happens, but it's fairly rare, is we did have one instance where the owner actually committed fraud and cooked their books. And one of the reasons we didn't find it is because they were also taking money out of their personal account or another business account. We're not sure where the money came from. And they were paying the rent or making it look like all of their residents were paying rent. And we didn't find out until after we purchased the property that the property that looked like it had somewhere between 92 and 94% economic occupancy actually only had 60% economic occupancy.
Oh, wow.
Yeah, there was 30 to 40% of the residents that were not paying rent. And we found that out after we purchased it and went knocking on the doors to collect rent. And a pretty common response we got was along the lines of, well, I haven't paid in 4 or 5 or 6 months, so why do you want it now? So when we went back and started doing our research, we found out that all of the bank statements added up, that all the rent looked like it was being paid. And so the only thing we can figure out is that the seller was not, or the seller was putting money into the account to make it look like the residents were in fact paying on time each and every month.
Wow. What recourse do you have in that instance?
Well, we took legal action. We ended up going after the seller. We sued the seller for damages. Unfortunately, the seller, of course, filed bankruptcy, and we had to make a decision between us and the investors when they filed for bankruptcy protection. The only way that we could continue our scenario and go after the seller was if we could prove the actual fraud. And so we did talk to some attorneys. We did talk to some private investigators. We talked to our CPAs to see what we could do if there was anything. Because if you can prove that fraud actually took place, that nullifies their bankruptcy protection. And so we actually spent a lot of money going after the seller. We spent a lot of money with our investigation. And unfortunately, they weren't able to find anything conclusive that would lead them to tell us that we had a pretty good chance of going after the seller and winning in court. So unfortunately, that was one of those things that we learned. How do you protect yourself in the future? Well, that's a good question. We thought we had done everything that we needed to do, and the seller just happened to be very, very good. We found out after the fact that he had multiple lawsuits, probably anywhere from 10 to 15 lawsuits against him, because this was not the only property that he pulled this on.
Wow. Sometimes you just deal with bad apples.
Yeah, sometimes, and you take your lumps, you learn from it, and you move on. And yeah, we couldn't even get the FBI to look into it, or actually, I guess they did look into it. We lodged a complaint with them, but they weren't able to find anything to our knowledge as well.
Mm. Now, you mentioned that you typically will retain the existing management company, so it sounds like you're dealing mostly with third-party professional management companies. How does that work out for you? Because I know there's always this debate about bringing in your own management team versus using third-party management. Why is it you choose to use third-party management?
Well, the main reason we choose to use the third-party management is because we're spread out all over the country, and we don't have enough units in a particular market in order to justify having our own management team in place. So if you own 60 units here, and a couple hundred miles away you've got 110 units, and a couple hundred miles away you've got 150 units, that's great, but it's not conducive to you having your own management company. Somebody on your own team is not going to necessarily be able to drive around and check out all those different locations on a regular basis. So it's just easier for us to have a third-party management company that's there full-time. They're watching over the property. They're watching over the residents. And, of course, if they don't do what they're supposed to do, then we change them. We'll fire them. We'll bring in somebody new.
And what are some of the costs and considerations for our listeners who are looking at apartments or multifamily and wondering what management is going to cost and how they should make sure they're doing the job correctly?
Sure. Well, the cost is, compared to a single family home, is actually a lot less. So with because you own so many more units, we, of course, expect and get a discount on the management fee. So in a lot of our properties, where most people in single family homes are paying somewhere between 8 and 10% management fee, we're generally paying somewhere between 3.5% and 4.5% for our management fee. The other plus to having third-party management and on-site management with our larger projects is just the fact that they are on-site. They're there 5, 6, 7 days a week, so they're able to react faster if something's going on the property. The residents don't necessarily have to pick up the phone and call somebody. They can just walk up to the office, knock on the door, or walk into the office and let them know that there's a problem, or pay their rent, or whatever it is that they need to do. So one of the other costs, of course, that goes along with the on-site management and on-site maintenance is there is a pass-through of their salaries. So their salary, whatever their hourly salary is passed directly through the management company to us. But still, by having somebody on site, we're still generally paying less than that 8 or 10% amount that most people would be paying for in their single-family homes. And we also have the added advantage of having somebody on site to watch over the property on a daily basis.
Now, if you're taking over a property and you're looking to improve it, do you find that it's a struggle with the management company that was already in place and doing their job to kind of change their culture or their mindset when it comes to managing the property the way you like to see it managed?
It's about a 50-50 proposition. Certainly, we've been banging our heads against walls with some of the managers, trying to get them to change some of the things that they're doing. And other half of the time, people absolutely love some of the new concepts that we come in with. And not only do they love the concepts ourselves and do them on our property, but then they adopt those same philosophies and use them on their other properties, which just makes them more valuable to their other clients. So yeah, it's a toss up there. Sometimes you're fighting those old bad habits and trying to get people to change. And the other half of the time, people love the new philosophies, they love the new ideas, and they embrace them.
So since you've been investing since 2004, I'm curious what your perspective on the market is. I invest primarily in Grand Rapids, Michigan here, and I know in the past several years the market has really tightened, and the properties are trading at a lot higher value than what I'm used to or willing to pay. What's your perspective?
Well, that's a great question. So certainly there's a lot of markets out there that have gone through the roof, but all of the cycles when it comes to apartment investing are local. There's 7 different things that make up the market cycles. 3 of them are basically controlled by the government. You've got inflation, you've got liquidity in the funds, and interest rates. But then the local markets are all driven by in or out migration, how many people are moving in or out of a particular market, and job growth and population growth and things like that. And so certainly there are some local markets like Denver and Dallas and even Houston, not Houston, but Seattle, that have just been going through the roof like crazy. And there's a lot of economists in those markets that still think there's room to grow, even though those markets have been going up exponentially since about 2009. But what we've done is we still invest in some of those hot markets, but we've changed our strategy. Instead of buying properties that are already running extremely well, which are potentially maxed out as far as gain of value, we're now looking for properties that have been neglected. So there's a lot of A-class properties, brand new properties going into a lot of these big markets, like I mentioned, Seattle, Denver, Dallas, even Houston. But we're now going to, because not everybody can afford the rents on those newer properties. We've got some properties here in downtown Denver. There's one it's called a micro apartment. They basically was an old hotel, so 200-ish to 300-ish square feet. They're getting anywhere from $1,200 to $2,000 per month rent on this property, depending on the floor of the unit. It's like a 38-unit building. And all they did was take this old hotel and convert it into a bunch of these micro apartments. Well, not everybody can afford $2,000 a month. But if we can find an apartment close to that site that's been neglected for a few years, that has a lot of deferred maintenance, we can usually pick that up at a pretty good rate, put more money into it to fix it up, to spruce it up, new cabinets, new paint, new countertops, new appliances. And we can generally do that for around $5,000 per unit, maybe $7,500 per unit. But we can increase the value exponentially. Matter of fact, we did that on one property. We ended up picking up a 94-unit property that was completely vacant for $311,000. Wow. We put another $800,000 into it, so we got about $1.1 million into the property. And when it was completed, the appraisal came back at just under $2.5 million. So what we're doing is we're still going into some of these same hot markets, but we're not competing with, as you say, the higher valuations on some of these properties that have already been maxed out in valuation, in our opinion. We're looking for the properties that are next to them where the value hasn't been maxed out. And we can go in and turn those around, do some fix up, raise the rent, and compete with the newer products, but not in a not so new building, maybe something that's 30, 40 years old, because not everybody wants to pay or can afford to pay $2,000 a month. We might turn ours around from a $1,200 per month unit to a $1,500 per month unit. There's still a lot more people out there that are interested in those types of properties in those markets, and we're making a killing doing it.
So would you say that your acquisition criteria is traditionally B and C type properties with value add components to them?
Yeah, definitely. Yes.
And you're not afraid to buy something that's way underperforming and do some rehab up front?
Oh, absolutely not. As long as the numbers work and we can buy it at the right price. As I mentioned, we had the one that was the $311,000 one that was completely vacant. 94 units, completely vacant. Purchased that, increased the value tremendously. We've got another property, it was 119 units. Bought that one, did some work on it, increased the value over $1 million. So that's what we're pretty much targeting now, that some of these markets have been maxed out. We're still going into some of those very high-priced, popular markets, but we're not looking for the cream of the crop. We're looking specifically for the ones that have that value-add opportunity that have been neglected, generally properties that are 30, 40, 50 years old.
That 96 unit that was completely vacant that you bought for $311, I find that interesting. Can you tell us a little bit more about that? Like how you found it, how you were able to take it down? I can't imagine you were able to put financing on it if it was completely vacant.
No, the $311,000 was cash, which came from investors, but it was found by one of my students who had actually purchased a property a couple blocks away. And he was in the process of fixing that property up. It was an 80-unit property. And while he was there in town fixing it up, this is actually in a small town in Kansas, and he lives in the Denver metro area, he noticed this other building that seemed to be completely vacant. And he started doing his research, and his wife was helping him do research. And they ended up finding out that the property was owned by the local university in town. And so they approached the university. They weren't getting anywhere with the university. So since it's a university, it's a government entity. So what they did is they ended up running it up the flagpole and even called the governor's office, stating that they were real estate investors. They were interested in purchasing this property, and they couldn't get any feedback from the state university. And the governor basically told them, you will hear from them within 48 hours. And sure enough, somebody from the university picked up the phone and called them. And they apologized and said one of the reasons they didn't call back is because they were trying to figure out what they were going to do with this complex. It used to be student housing, but they decided quite a few years ago that they were getting out of the student housing business themselves, and they were going to let the general market just take over the student housing. So they ended up we ended up creating a relationship with the university. The university put it out on their contractor's bid list. They didn't even list it with a real estate agent. They put it on their contractor's bid list, which is where they put out bids for contractors to do things like roof replacement, parking lot repairs or parking lot replacement, landscaping, HVAC work, plumbing work. There was nobody else out there that even knew about this property or even wanted it. We ended up being the only bidder on it and ended up getting the property. So the big thing that it came from was creating that relationship. So the students went out and actually started that relationship with the university in order to find out when it was going to be sold, how it was going to be sold, and what they needed to do in order to put in an offer. So they did. We did get it pulled down with a couple of investors. We bought the property itself for $311,000 in cash, and then once we did that, then we actually did get financing on the property. We got a construction to perm loan, and we used the property itself as the collateral in order to securitize the $800,000 loan that we got from the lender, which then turned into a permanent loan at $1.1 million. And the bank was very happy to do it because they knew before they even gave us a dime, when they did the original appraisal, that if we were able to do what we said we were going to do, the property would be worth over $2.5 million. And sure enough, we did what we said we were going to do, and the property's worth about $2.5 million. And now the bank's even coming back to us and asking us if we have any more deals. They've got more money to loan, and they want to know if we have any more projects.
That's fantastic. It's very commendable of your students to do that kind of legwork and create that kind of relationship on a property that must have been kind of difficult to even find the person to talk to about it. Do you have other success stories from your students that you'd like to share?
Yeah, I've got a few of them. I've got, let's see, I've got some students that are up over 800 units. They've been going out and creating relationships with people in different markets. They did start up their own management company because they have so many units within the Midwest between Iowa, Nebraska, and Oklahoma, that they started up their own management company. So one of the students, there's actually two main students. One of them oversees the management part of it. She hires all of the local management people on site. And then he actually takes care of the financing aspect of it, between talking to lenders and then, of course, raising funds from people. And they've raised, probably, my guess would probably be over $10 million for their different projects that they put together. So they're doing extremely well. I've got another student, if you don't have that kind of money or you don't want to own a couple hundred units, I've got some students that bought a little old 12-plex. They bought a 12-plex property a few years ago in Aurora, Colorado, just outside of Denver. They needed to raise, I think it was between $125,000 and $150,000 to purchase it. They did that without putting in any of their own money. They raised it from investors. I think they bought the property, I want to say, for around $450,000 or $500,000, and they kept getting calls just within the last couple of years. They kept getting calls from somebody who wanted to buy their property from different brokers because they weren't actually interested in selling, and they kept telling them, "No, we're doing great. The property's cash flowing great. We're not interested in selling." So finally, one of the brokers said, "Okay, what's your I don't want to sell price?" So they just threw out some ridiculous number. And the broker said, "Okay, thanks, I'll call you back." And sure enough, the broker called back later that day and said, "Sold."
Wow.
So, a matter of fact, I think they sold it for $950,000, and they've only owned it for about 5 years. So it went up, it more than doubled in value over that 4 or 5 year period that they've owned it. So
good for them, that's great.
Yeah, yep.
What about horror stories? Any horror or disaster stories that you can share?
Well, we have the one that I already told you about, where the seller basically defrauded us and they defrauded the lender because they were cooking the books. They were making payments on behalf of their residents to make it look like the property was performing when it really wasn't performing. So that was probably our biggest disaster. That was a 116 unit property in Wichita. And we actually ended up losing that property because there was no cash flow coming in on the property. or not enough cash flow to come in to continue the operations. So that was a long, arduous process, but we unfortunately ended up losing it. And the bank didn't even seem to care when we showed them the fact that the seller had actually defrauded both of us. They're like, well, that's nice, but we're foreclosing on you.
Ouch.
Yeah. The only other issue that we've really had that was bad was on a property down in Mississippi. I was trying to get my partner, and another partner who was the asset manager on the property, and I was trying to get him to change the property management company because the lady that was overseeing the on-site manager had to drive 3.5 hours from Shreveport over to the property. And she just wasn't focusing on it. The property wasn't performing as well as it should have been performing, and I kept trying to get him to change the manager. We also, every month, I was looking at the numbers on the property. The vacancy kept slowly going up higher and higher, and unfortunately, he was concentrating on physical occupancy, and I was concentrating on economic occupancy. And I could not seem to convince him, unfortunately, that he was looking at the numbers incorrectly and that we were in trouble with that property and it was not cash flowing the way that it needed to cash flow. And I kept sending him these reports. I would revise the reports that he was sending out to me and our investors. And I would send it back saying, look, economically, the property is not performing. We had, and it started out, we were around 8% vacancy, both physically and economic. And then the physical vacancies pretty much stayed where it was, but economically, a lot of the residents stopped paying their rent. And all of a sudden, we crept up to 12%, 13%, 14%, 15%, and it kept getting worse and worse. And I could not get him to pay attention. Well, he finally got to the point where the manager decided that she no longer wanted to make the drive. So she basically quit on him, thank God. But unfortunately, one of the other things that happened right before she quit, we actually got up to about 20% economic vacancy. And I'm screaming and yelling, and he's just not paying attention. He finally ended up changing the management company. And then actually shortly before he changed the management company, all of a sudden the vacancy that was creeping up to 18, 19, 20%, all of a sudden dropped back to 6 or 7% within a 1-month period. And I thought, well, that's pretty amazing. What the heck is going on? So I called him up and found out what was happening and what they did to change the environment. And he said, oh, well, what we did is we changed our requirements for residents, our income requirements. I said, what do you mean you changed your income requirements? We used to require 3 times income to rent. They dropped it to 2 times income to rent. So all of a sudden now we have all these extra residents that qualify that normally wouldn't be able to qualify. And so we got this huge insurge of residents that were able to qualify under the new terms. They paid their first month's rent. And the problem was after they paid their first month's rent, most of them never paid another dime. Wow. So all of a sudden we had this false hit of occupancy where the income just shot up. The occupancy shot back up to close to 95%. And then within the next 2 or 3 months, there were 40 residents that were put in under these new terms of 2-to-1 income to rent ratio. Within 2 to 3 months, 38 of the 40 had either already vanished, were in the process of being evicted, or had been evicted from the property. And now all of a sudden the vacancy shot up tremendously, or the occupancy dropped. So we went from about 20 up to about 5%, and now we're down back at 20 to 21 to 22, and the property's just bleeding cash. Well, at the same time, he finally gets rid of the property manager, basically because she quit. He brings in a new management company. The first thing they see is what the rental requirements had been changed. They're freaking out, going, you need to stop this immediately. And of course, my partner goes, okay, fine. So they take it back up to 3-to-1 income to rent requirement. They start putting new residents in. But then at the same time, we also had a rainstorm that came through Mississippi. And even though there's a creek that runs through the property, we didn't have any problems with the creek. But the property is right next to a frontage road, and there was so much water and rain on the frontage road that it came down the frontage road, down the side of the property, and actually washed out the foundation underneath the end of one of our buildings. Oh, so wow. There's like 13 or 14 7-unit buildings. And one of these 7-unit buildings, it washed out the foundation on the 2 end units. So literally the 2 end units actually cracked and fell away from the other 5 units. So not only did we have the issue with the vacancy and the occupancy that I already mentioned, we had this huge rainstorm that came through that, of course, was not covered by insurance because it was considered a flood, and we didn't have flood insurance because my partner was too cheap to get flood insurance, even though there was a creek running through the middle of the property. And then the third thing that happened is one of the other reasons I was trying to get him to get rid of the property manager is her bookkeeper was changing the financial statements. And so I went, because as I was going through it and looking at the financial statements every month, I was noticing that numbers in previous months were changing. And I said, okay, this is odd. And I brought it to his attention, and we ended up finding out that she was putting, as an example, we had water bills that were due every other month, and we had insurance payments that were due once a quarter. Well, my partner looks at all the numbers, sees how well everything is going, or how well he thinks it's going because of how the bookkeeper is taking care of the books. He looks at the bank account, sees that we have this huge extra balance in our bank account. He decides to make a distribution to the investors. So we distribute $60,000. Then we have the issue with the vacancy, the issue with the flooding from the rainstorm, and then come to find out that because the bookkeeper was doing the books incorrectly, she wasn't stealing or anything. She just was putting numbers where they shouldn't have been, and it looked to my partner as if bills had been paid, and in fact they had not been paid. So when the new management company comes in and finds out that there's now damage to several of the units because of the flooding, the income is low because the 2-to-1 requirement, and now our economic occupancy is in the high 70s, and the fact that these bills hadn't been paid, we went from doing a $60,000 distribution to requiring a $125,000 capital call.
Ouch.
From our investors because of all these extra issues that popped up. And if we had not done the $60,000 distribution, we would have been fine. But unfortunately, it happened. It was a very bad pun, water under the bridge. And so we ended up getting behind the 8 ball on that particular property, and that was within 6 months of purchasing it. So that's the only real other horror story I have. And even though I wouldn't even say it's a horror story. Certainly it was a series of bad circumstances that added up. But ultimately, the investors actually made out very well. They didn't get any cash flow from the property because we were behind the 8 ball from 6 months into it, and were never able to do another distribution. But at the end of the day, when we sold the property 4 or 5 years later, we ended up paying our investors about a 12% rate of return each year for the period of time that we owned the property. So over that 5-year period, they basically ended up with a 60% return on their investment. So even though there wasn't a lot of cash flow or no cash flow from the property, it still turned out all right for the investors. So that's our.
I'll bet you were happy to sell that one.
Yeah, that one we were actually happy to sell.
Yeah, well, it really seems like it started with just a bad management, and then your partner being unwilling to fire that bad management and bring in better management, and then just making really self-sabotaging decisions against your better instructions and better judgment. So that's a tough one. How do you deal with that kind of psychology where you have someone in place making these decisions who just really shouldn't be?
Well, and one of the reasons he was in charge is he was actually the guy that sold a bunch of his properties in California to get out of California. He had 8 complexes in California and several hundred units already there before he moved out and started buying in other areas in the southeast of the United States. I think one of the problems is it's like he was making decisions based on the quality of the residents in the property, unfortunately. I found out after the fact that he were treating a lot of our residents in a very bad situation. He thought a lot of them were gangbangers. He thought a lot of them were drug dealers. And if that was his thought process, we never even should have went in and bought some of these properties. And it wasn't because they were gangbangers and drug dealers. Unfortunately, like I said, I found out after the fact that he turned out to be a racist. And if I had known that ahead of time, I never would have invested with him. So, how do you fix that? Well, once you find out about some of these issues, what I did is I made the conscious decision that I was never going to invest with him again. Not only in any of his deals, but I was not going to let him come into any of my deals. One of the reasons I actually was partnering with him is because not only was he putting in a considerable amount of his own money, but he was also signing on the loans as the guarantor for the loans. So that's one of the reasons we partnered with him in the first place. But then after we found out that he was not willing to listen to any advice from anybody other than himself or the property manager, that's not a good combination. He was not open to hearing or discussing any type of feedback from anybody that wasn't himself.
Wow.
And so once you find out that somebody is that closed off and they're not willing to listen and look at, as I mentioned earlier, I kept showing him the numbers and how he was looking at the numbers incorrectly. He was concentrating on physical occupancy instead of economic. And he kept just coming back and saying, well, the property manager says it's not a problem. Property manager says it's not a problem. And he just would not listen to anybody else. And so once that started happening, I just decided I was never going to be investing with him again, because it was you have to have somebody who's open-minded and willing to take criticism and learn from the criticism.
Yeah, wash your hands of that guy.
Yep.
So what have I not asked you that you'd like to talk about when it comes to multifamily and apartments?
I think one of the big things I get from people a lot of the time is this right for them? Is this something that they can do? They have little to no money. Is it something that they can get into? And the answers are, well, as far as whether it's something you should do, that is a personal decision you need to make. Apartments aren't for everybody. Single family homes aren't for everybody. Strip malls aren't for everybody. Everybody has their own forte of what they want to do and what they want to get into for a variety of reasons. So I think one of the biggest things that people should do before they start investing in multifamily or any type of property is learn. Get some type of education, read some books, do something to learn about that particular asset class, number one. Number two, if you decide it is something that you want to get into, don't let the fact that you don't have any experience or don't have any money or don't have any credit hold you back. When I started investing in real estate and single family homes, I went to a couple of the gurus and they basically said, look, you don't have to have any cash or any credit to buy properties. Here's how you do it. And I said, great. And I went out and I started doing it back in the early 2000s. And I bought several properties with no money. People literally just handed me the keys to their property. And I thought, okay, this is great. I'm going to continue doing it. So I learned from more people. I learned from my mentors. I learned from gurus on how to buy a multifamily. And so what did I do? I went out and I started buying it. And I also realized from listening to them that, again, you don't have to have any of your own money. You don't have to have any of your own credit. You don't have to have experience. So the very first deal that we bought that we talked about earlier in the podcast was a 14-unit property we bought in Oklahoma. Well, we didn't sign on the loan and we didn't put in any of our own money. As a matter of fact, of the 1,700 units that I've been part of, I probably have less than $100,000 out of my pocket combined for all those units. And I have not signed on a single loan document for any of those apartment complexes. I have people that are willing to sign on the documents for me in exchange for a piece of the deal. So I am living proof that you can do this without any of your own money, that you can do it without any credit. Even though I actually have good credit and I have good money, I still don't use my money or my credit to buy any of these properties. And when we first started up, I didn't have any experience. Wow. At least buying apartment buildings. So all this stuff can be done as long as you believe you can do it and don't let the naysayers hold you back.
And make sure you get the proper training and education to do it right. And thanks for teeing up my promo for the RPOA annual conference. You'll be speaking February 23rd. The conference is February 22nd through 24th of 2018, and it's here in Grand Rapids, Michigan. It's free. And you can go to rpoaonline.org to register. Anthony, why don't you just tell our listeners why they should come hear you speak and what they'll be getting out of your presentation?
Sure. Well, I think one of the biggest things, one of the biggest reasons they need to come is because I start off my presentation with an update on the local market. I will actually do research on the Grand Rapids market, and that's how I will start my presentation, by going through what's happening right now in Grand Rapids. Is now a good time to be buying apartment complexes in Grand Rapids? Yes or no? Well, you'll find out. I'm going to be showing people different websites that I go to find out information on the economy. Is the economy growing? Is the economy receding? Is the population growing? Is the population receding? What are the experts projecting for job growth over the next couple of years to 10 years in that particular area? So I'm going to start with that. So that's be a great reason for them to come. Whether they're interested in apartments or not, it's still going to be valuable information, because you need to know this information no matter what you're investing in. The other thing I'm going to talk about is, depending on what's happening right now in the Grand Rapids market, is, should you be buying apartments? As I mentioned earlier in the podcast with you, Brian, we're still buying in areas that are maxed out in value, but we've changed our strategy. We're no longer looking for the cream of the crop type properties. We're now looking for more value add type properties that owners have been neglecting for a variety of reasons. So to me, it's always a good time to be buying real estate, but you may have to change your strategy on the type of real estate that you purchase, or the location, or the level of property, whether you're buying the cream of the crop or something that's more value add. So I'm going to be talking about all of that during my presentation on Friday afternoon.
Great. Well, Anthony Chara, it's been a fascinating conversation. I always love talking multifamily and apartments, and your experiences are definitely unique and interesting. And I can't wait to hear you come speak February 23rd at the RPOA annual conference. And you can go to rpoaonline.org to register for free. Thanks so much for taking the time to talk with us today.
Well, thanks, Brian. I appreciate you having me on, and I look forward to seeing you on February 23rd.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.